ExamPrep.School. Texas General Lines Life Accident and Health Insurance Exam. Exam code INSTX-LAH05. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Application, underwriting, and policy delivery. Field underwriting procedures. Health policy provisions, clauses, and riders. Other insurance concepts. Policy riders, provisions, options, and exclusions. Retirement and other insurance concepts. Social insurance. Statutes and rules common to life and health. Statutes and rules pertinent to accident and health. Statutes and rules pertinent to life. Types of policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following is a feature of a level term life insurance policy? A. Level premium with decreasing death benefit over the term. B. Level premium and level death benefit throughout the term. C. Premiums increasing at each renewal with level death benefit. D. Level death benefit with built-in cash value accumulation. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is that both the premium and death benefit remain constant during the policy term, which distinguishes level term policies from other term variants. Reason A is not correct. That describes a decreasing term policy where the death benefit declines over the term. Reason C is not correct. Premiums increasing at renewal apply to annually renewable term, not level term. Reason D is not correct. Cash value accumulation does not occur in term policies. It is a feature of permanent coverage. Question 2. Which feature is specific to a decreasing term life insurance policy used for mortgage protection? A. Premiums decrease periodically as the insured ages. B. Death benefit equals the outstanding mortgage balance at the time of death. C. Level premium and level death benefit throughout the term. D. Cash value accumulation increases over the term. The correct answer is B. The defining characteristic is that the death benefit declines in line with the remaining mortgage balance, while premiums typically remain level. Reason A is not correct. Premiums generally remain unchanged in decreasing term designs, not decrease with age. Reason C is not correct. Both level premium and level death benefit describe a level term policy, not decreasing term. Reason D is not correct. Cash value accumulation is a feature of permanent policies, not of decreasing term coverage. Question 3. In a return of premium term life policy, when is the accumulated premium refunded to the policy owner? A. Upon surrender before the expiration date. B. Upon conversion to a permanent policy. C. Upon policy lapse due to non-payment. D. At the maturity date if the insured remains alive. The correct answer is D. A return of premium term policy refunds all paid premiums at contract expiration provided the insured survives the term. No refund occurs at conversion or lapse. Reason A is not correct. Surrender provisions do not apply since refunds occur only at scheduled expiration. Reason B is not correct. Conversion exchanges term for permanent coverage rather than triggering a refund of premiums. Reason C is not correct. A lapse forfeits coverage and premiums instead of producing a refund. Question 4. Which best describes the conversion privilege available under a renewable term life insurance policy? A. Conversion option is only available if the death benefit exceeds a predetermined threshold. B. Conversion requires proof of insurability and payment of adjustable premiums. C. Conversion must occur within the first policy year with no additional premium. D. Insured may convert to a permanent policy without evidence of insurability before a specified age limit. The correct answer is D. The conversion privilege permits exchanging term coverage for permanent insurance without evidence of insurability, usually up to a specified age with premiums based on attained age. Reason A is not correct. Conversion eligibility is not contingent on death benefit size but on policy terms. Reason B is not correct. Conversion privileges waive insurability requirements. Adjustable premiums are unrelated. Reason C is not correct. Limits typically extend beyond the first year. Conversion after year 1 is often allowed. Question 5. When a 40-year-old insured purchases a 10-pay limited pay whole life policy, which accurately describes the premium payment schedule and policy status after the payment period, A. He pays level premiums for life and the cash value is paid out at age 100. B. He pays level premiums for 10 years, after which no further premium payments are required and the policy remains in force. C. He pays level premiums until age 65, then only the cash value is available upon surrender. D. He pays annual flexible premiums for 10 years, after which premiums are waived only if the cash value equals the face amount. The correct answer is B. In a 10-pay limited pay whole life policy, the insured makes level premium payments only for the specified 10 years. Once that period ends, no additional premiums are due, and the policy continues in force with cash value growth continuing. Reason A is not correct. Describes a straight whole life policy that requires level premiums for life, not a limited pay contract. Reason C is not correct. Alters the specified payment period to age 65 instead of the 10-year term defined by the contract. Reason D is not correct. Confuses limited pay whole life with universal life, which allows flexible premiums and waivers tied to cash value. Question 6. Analysts reviewing a straight whole life policy issued to a 30-year-old client note its guaranteed cash value behavior. Which description accurately reflects its accumulation pattern? A. Cash values grow at a rate linked directly to the insurer's current investment yield. B. Cash values remain below the death benefit initially, then increase more rapidly in later years, eventually matching the face amount. C. Cash values are fully credited to the policy's cash account during the first 3 policy years. D. Cash values increase only through dividend additions and are not guaranteed by the contract. The correct answer is B. A straight whole life policy provides guaranteed cash value that starts slowly and accelerates in later years, ultimately equaling the policy's face amount at maturity. Growth is contractually guaranteed, independent of the insurer's current yields or dividends. Reason A is not correct. Incorrect because guaranteed cash values are not tied solely to current investment yields. Reason C is not correct. Incorrect since cash value does not fully credit in the initial policy years. Reason D is not correct. Incorrect because guaranteed cash values are independent of dividend payments. Question 7. A policy owner selects option A for her $250,000 universal life contract. As cash value builds over time, which statement correctly compares the net amount at risk under option A versus option B? A. Under option A, the net amount at risk remains constant. Under option B, it decreases over time. B. Under option A, the net amount at risk decreases as cash value accumulates. Under option B, it remains level equal to the original face amount. C. Under option A, cash value accumulation increases the net amount at risk. Under option B, it decreases the net amount at risk. D. Under option A, the net amount at risk fluctuates with premium payments. Under option B, it is unaffected by cash value changes. The correct answer is B. With option A's level death benefit, the net amount at risk, death benefit minus cash value, declines as cash value grows. Under option B's increasing death benefit, The net amount at risk remains constant at the original face amount because death benefit rises in line with cash value. Reason A is not correct. Inverts the correct relationship. Under option A, the net risk declines, not remains constant. Reason C is not correct. Incorrect because cash value accumulation reduces, not increases, net risk under option A. Reason D is not correct. Incorrect since net at risk under option A is driven by cash value, not directly by premium timing. Question 8. An insured's universal life policy with option A shows an end-of-year cash value of $120,000 and a death benefit of $140,000. The IRS corridor requirement for the insured's age mandates a 25% corridor. Which action must the insurer take to maintain IRC compliance? A. Reduce the cash value to $112,000. B. Increase the death benefit to $150,000. C. Reclassify the policy as a modified endowment contract. D. Convert the deficiency into a term rider to cover the shortfall. The correct answer is B. To satisfy the IRS corridor requirement of 25%, death benefit must equal at least 125% of cash value. With cash value at $120,000, the death benefit must be increased to $150,000 to maintain compliance. Reason A is not correct. Regulators do not allow reducing guaranteed cash values to meet corridor tests. Reason C is not correct. Failing a corridor test does not trigger a MEC reclassification. Reason D is not correct. Adding a term rider for the shortfall is not the prescribed method for corridor compliance. Question 9. Which of the following factors does not influence the calculation of periodic payments for a single premium immediate annuity? A. The amount of the single premium paid. B. The assumed interest rate. C. The annuitant's age and gender. D. The duration of the accumulation period. The correct answer is D. The correct answer is the duration of the accumulation period, because single premium immediate annuity payments are based on the premium amount, assumed interest rate, and mortality assumptions rather than any accumulation period. Reason A is not correct. This is wrong because the premium amount directly determines the funds available for payout. Reason B is not correct. This is wrong because the assumed interest rate directly affects the payment calculation. Reason C is not correct. This is wrong because age and gender inform life expectancy used in the payment schedule. Question 10. Under current U.S. tax rules, which withdrawal ordering rule applies to distributions taken during the accumulation phase of a deferred annuity? A. First in, first out method. B. Last in, first out method. C. Pro rata method. D. Modified endowment contract rule. The correct answer is B. The correct answer is the last in, first out method, which requires earnings to be withdrawn before the return of principal during the accumulation phase. Reason A is not correct. This is wrong because the first in, first out method does not apply to annuity withdrawals. Reason C is not correct. This is wrong because the pro rata method applies to certain retirement distributions, but not to deferred annuity accumulations. Reason D is not correct. This is wrong because the modified endowment contract rule relates to funding tests, not withdrawal ordering. Question 11. In a flexible premium deferred annuity, a surrender charge is typically calculated as which of the following? A. A fixed dollar fee per withdrawal. B. A percentage of the accumulation value based on a scheduled decline. C. A percentage of each premium paid. D. A flat percentage of the death benefit. The correct answer is B. The correct answer is a percentage of the accumulation value based on a scheduled decline, which decreases over the surrender charge period. Reason A is not correct. This is wrong because surrender charges are not expressed as a fixed dollar fee per withdrawal. Reason C is not correct. This is wrong because charges apply to the accumulation value, not each premium. Reason D is not correct. This is wrong because surrender charges have no relation to the death benefit percentage. Question 12. A deferred equity indexed annuity credits interest based on an S&P 500 gain of 14% for the contract year and applies a 75% participation rate with no cap or spread. What interest rate will be credited to the contract? A. 10.5%, B. 14%, C. 9.8%, D. 7%. The correct answer is A. The credited interest equals the index gain multiplied by the participation rate. 14% multiplied by 75% equals 10.5%. Reason B is not correct. This reflects the full index gain without applying the participation rate. Reason C is not correct. This uses a 70% participation rate instead of the stated 75%. Reason D is not correct. This reflects a 50% participation rate rather than the stated 75%. Question 13. A Texas licensed agent holding only a life insurance license wants to sell variable annuities. Which additional credential must be obtained before selling contracts tied to a separate account? A. FINR. A. Series 6 Securities Registration and State Securities Approval. B. Property and Casualty Insurance License. C. Public Adjuster Certification. D. Health Maintenance Organization Certification. The correct answer is A. State law requires agents selling variable annuities to hold both a life insurance license and a FINRA, securities registration plus state approval. Reason B is not correct. A property and casualty license does not authorize sales of securities or variable contracts. Reason C is not correct. A public adjuster certification relates to claims adjustment, not selling securities. Reason D is not correct. HMO certification covers health plan administration, not variable annuities. Question 14. A deferred annuity contract includes a mortality guarantee provision that keeps mortality charges level for the first 5 years. After that guarantee period ends, what is true about mortality charges? A. They may be adjusted based on the insurer's actual mortality experience. B. They remain fixed for the life of the contract regardless of experience. C. They may be increased only with the annuitant's written consent. D. They may be adjusted to reflect general economic conditions. The correct answer is A. Once the guaranteed period ends, mortality charges can be adjusted to reflect actual mortality experience, as allowed under the provision. Reason B is not correct. The guarantee only applies during the initial period, not for the entire contract. Reason C is not correct. Policy owner consent is not required for permitted adjustments after the guarantee period. Reason D is not correct. Economic conditions are not a factor for mortality charge adjustments under this provision. Question 15. In a major medical health plan, the coinsurance provision obligates the insured to pay A. A fixed dollar amount per covered service before benefits apply. B. The entire cost of eligible expenses up to the policy's benefit limit. C. All covered expenses until an overall out-of-pocket maximum is reached. D. A percentage of covered expenses after the deductible is satisfied. The correct answer is D. This option is correct because coinsurance requires the insured to pay a specified percentage of covered expenses after meeting the deductible before the insurer begins its share. Reason A is not correct. This describes a copayment rather than a percentage-based cost share under coinsurance. Reason B is not correct. This describes responsibility before benefits begin, not the shared percentage after deductible. Reason C is not correct. This describes the out-of-pocket maximum limit, not co-insurance cost sharing. Question 16. In an HMO using the gatekeeper model, what primary function does the gatekeeper physician serve? A. Authorize patient referrals to specialty providers. B. Negotiate reimbursement rates with network hospitals. C. Manage claims processing for enrolled members. D. Develop actuarial projections for premium setting. The correct answer is A. This option is correct because the gatekeeper physician coordinates care by evaluating needs and approving referrals to specialists within the HMO network. Reason B is not correct. Negotiating rates is typically handled by the plan's contracting department rather than the gatekeeper physician. Reason C is not correct. Claims processing is managed by administrative staff, not the gatekeeper physician. Reason D is not correct. Actuarial projections are prepared by analysts rather than the gatekeeper physician. Question 17. Preferred providers in a PPO typically agree to accept what type of reimbursement arrangement? A. A predetermined discounted fee schedule for covered services. B. A percentage of billed charges with no annual maximum. C. Usual and customary charges at time of service. D. Fee-for-service payments based solely on charge limits. The correct answer is A. This option is correct because PPO preferred providers accept a negotiated discounted fee schedule rather than full billed charges or standard customary rates. Reason B is not correct. A percentage of billed charges with no maximum does not reflect the negotiated discounted schedule and would leave costs uncontrolled. Reason C is not correct. Usual and customary rates apply to non-preferred providers, not those in the PPO network. Reason D is not correct. Fee-for-service based solely on charge limits lacks the negotiated discount characteristic of PPO agreements. Question 18. Marcus is enrolled in an exclusive provider organization EPO plan and schedules a specialist visit without obtaining a primary care referral. The specialist visit is in-network, but Marcus learns his preferred out-of-network chiropractor visit would not be covered. Which characteristic best explains this coverage scenario for EPO plans? A. Requires designation of a primary care physician for all specialist visits. B. Covers out-of-network services at a reduced coinsurance rate. C. Provides coverage only for in-network providers except in emergencies. D. Allows out-of-network care without referral but at higher cost sharing. The correct answer is C. EPO plans restrict coverage to in-network providers except for emergencies, and do not reimburse out-of-network providers under normal circumstances. Reason A is not correct. A referral requirement is typical of some HMOs, but EPOs generally do not require PCP referrals for in-network specialist visits. Reason B is not correct. Out-of-network service coverage at a reduced coinsurance rate is a feature of PPO plans, not EPOs. Reason D is not correct. Allowing out-of-network care without referral suggests some coverage applies, which contradicts the exclusive network limitation of EPOs. Question 19. Under a point-of-service POS health plan, Leah visits an out-of-network specialist without securing an in-network referral. After meeting her deductible, what financial outcome is Leah most likely to face? A. Full denial of benefits for the out-of-network specialist. B. Reimbursement equal to 100% of billed charges. C. In-network coinsurance rate with no additional surcharge. D. Coverage at a lower coinsurance rate after applying the deductible. The correct answer is D. POS plans allow out-of-network services but typically reimburse at a lower coinsurance rate after the deductible rather than denials or in-network rates. Reason A is not correct. Out-of-network visits aren't usually denied under POS plans. they incur higher cost sharing instead. Reason B is not correct. Reimbursement equal to billed charges does not reflect typical cost-sharing features of POS plans. Reason C is not correct. In-network coinsurance rates apply only to network providers, not to out-of-network under a POS. Question 20. Derek applies for a short-term medical plan advertised as renewable monthly up to 9 months, but the insurance department in his state limits such plans. What is the maximum duration? Derek's short-term medical coverage can legally remain in force without conversion. A. Up to 9 months initial term only. B. Up to 12 months with unlimited renewals. C. Up to 36 months including renewals. D. Up to 364 days with no renewals. The correct answer is D. State regulations cap short-term medical policies at no more than 364 days in duration. Renewals beyond that constitute a new plan or conversion. Reason A is not correct. 9 months is an oversimplified term. The legal limit is up to 364 days. Reason B is not correct. Unlimited renewals would exceed regulatory duration limits for short-term medical plans. Reason C is not correct. Cumulative coverage of 36 months exceeds the permitted single policy term for short-term plans. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.